What is futures trading? A beginner's guide. If you've ever wondered how people trade the NASDAQ, S&P 500, oil, gold, or Bitcoin without owning the actual asset, you're in the right place. Futures trading may sound complex, but the basics are easier than most people think. A futures contract is an agreement to buy or sell an asset at a set price in the future. Futures were originally created so businesses could lock in prices and reduce uncertainty. Today, most traders never take delivery of the asset. They simply buy and sell contract to profit from price movements. Futures markets cover a wide range of assets, including stock indexes, S&P 500, NASDAQ, Dow Jones, gold and silver, crude oil and natural gas, corn, wheat and coffee, treasury bonds, Bitcoin and Ethereum. Many beginners start with stock index futures because they are highly liquid and trade nearly 24 hours a day. Popular contracts include ES, S&P 500, NQ, NASDAQ 100, YM, Dow Jones, and RTY Russell 2000. Futures offer several advantages. Profit in rising markets by buying contracts. Profit in falling markets by selling first and buying back later. Nearly 24-hour trading from Sunday evening through Friday evening. High liquidity, making it easier to enter and exit trades quickly. Leverage allows traders to control a larger position with a smaller amount of capital. This creates greater opportunity but also increases risk. Small price moves can produce much larger gains or losses than expected, so leverage should always be respected. Futures prices move in small increments called ticks. Every contract has its own tick size, and each tick is worth a fixed dollar amount. Learning tick values is one of the first skills every new trader should master. Margin isn't money you're borrowing. It's a good faith deposit required by your broker to open and maintain a futures position. If your account falls below required levels, you may need to deposit more funds or your position could be closed. Futures markets are used by banks, hedge funds, pension funds, farmers, airlines, energy companies, professional traders, individual retail traders. Some use futures to manage business risk, while others trade purely for profit. The biggest beginner mistake. Many new traders believe success comes from predicting market direction. In reality, long-term success depends more on risk management than perfect entries. Successful traders focus on protecting capital, limiting losses, using consistent position sizing, following a trading plan. Futures trading offers incredible opportunities, but it isn't easy. Before risking real money, spend time learning how contracts work, understand leverage, practice on a simulator, and develop a solid trading plan. Never trade money you can't afford to lose. Final thoughts. Futures trading is a professional market used by institutions and individual traders worldwide. The opportunities are real, but so are the risks. The traders who succeed aren't always the smartest. They're the most disciplined. They manage risk, stick to their plan, and continue learning over time. If you found this guide helpful, subscribe for more beginner-friendly articles on futures trading, risk management, trading psychology, and practical strategies. Educational purposes only. This is not financial advice.